Hey, welcome back to the Explore podcast with Scott and Ryan. We like to talk about real estate, entrepreneurship, motivation, and much more. Scott, what's going on?
Hey Ryan, not much. How we doing?
Doing good. So we got a fun episode today. We got a guest on, Reed Rickenbach. He is an agent investor out of Memphis, Tennessee. Reed, thanks for coming on. How you doing?
I'm doing great, man. Thank you so much for having me on. This is my first podcast. So I was just telling y'all I'm going to try not to say anything stupid.
Hey, well,
Hey.
that's great for us.
Yeah. Hope I don't get
No, we
killed.
like dumb. The dumber, the better. Like I was saying, hey, that's what gets everybody to click on and like these things. So it makes it more fun, and the interactions we get from the stupid comments or the mistakes we make are great. So whatever
No
happens,
doubt.
happens, man. This is going to be fun, and excited to learn a little bit more about you.
Yeah.
Tell us a little bit about yourself. Kind of what your background is. I know Ryan gave us a little bit of highlight, but give us a little more of your background, kind of what you're doing in the real estate world, and kind of how you got involved in everything.
So came to Memphis for college in 2015, 16, and
Uh-huh.
started working full time in college pretty early. I started working
You
40
said I
hour.
came from, so you from Little Rock, is that right?
That's right. Yeah. From Little Rock, born and raised in Little Rock.
Okay.
And I started working full time pretty early in college, like 40-hour weeks. I was a finance major, and so I got an internship sophomore year in college, and eventually was an
Very
analyst
nice.
role. Yeah, it was eventually an analyst role in junior year, and then moved companies and like had a full time salary work by senior year of college. And so, what kind of benefited me in real estate investing was that I was graduating with 2 years of tax returns. So I was bankable at that point. Ended up saving a lot of money through college and purchasing my first house in 2019, right before I graduated. Had two
You were
roommates living
young.
there. Yeah, I was young. I believe I was 22 when I got that house. And that house, man, that was 2019. I'm just glad I can say I got in before the craziness happened. I can claim I was a pre-COVID real estate investor,
Hey,
you know?
2019 was prime time, man. I mean, the rates were
Yeah,
still probably four-ish at that time, which is still very good. But uh, everything I bought in 2019, kind of like you're saying, before COVID, man, it blew up.
you hit it right on the head. It was 4.25 was the interest rate. And man, that house planted a seed, and it was just a beautiful time to get leveraged into real estate and have a motivation to keep growing a real estate portfolio at that time, because that house really planted a seed for growing the rest of what I ended up doing. So over the last few years, we bought and
Well, let's
sold.
slow down actually real quick and stop there for a second. So you said you bought your first house. What did you buy? Tell us a little bit more about this first
Yeah,
purchase. What made you get into what got you excited about buying it young? Why did you make a decision to buy where you bought it? Tell us a little bit about this house.
yeah, absolutely. This is I love thinking about this. I came to University of Memphis. It's not a very expensive school, but to kind of backtrack, my parents had me at 40 years old, and they are lifelong career people, extremely hard workers, and so they had actually saved up for their kids to go to college. Since they had kids late, they kind of had the ability to save money for us to go to college. Anyways,
That's awesome.
I ended up getting a majority of academic scholarship to the University of Memphis. So there was really not much tuition to pay. And so we started thinking about, well, there's going to be a housing
Hang on. So
cost.
you're saying you're pretty smart.
Well, I don't think the University of Memphis is a very high bar. I hope no one's listening from the school, but um, yeah. So, anyways, we started thinking about housing costs in college, and what we ended up doing was buying a $68,000 house in Memphis for me to live in college. And
Wow.
they put 18. Yeah, so it was very cheap over here. We didn't know it wasn't actually in the best area of Memphis because we weren't from here. So I actually ended up
Classic.
living in Orange Mound. If anyone from Memphis is listening, it's not the best area. Anyways, they put 18,000 down on the house. The mortgage was about $400 while I lived in college, and I had a roommate, Ladarius, who paid $500 a month. And so it was washing the housing costs while I was in college. and my parents still weren't coming out of pocket. And then they ended up selling the house to my roommate for $10,000 more than they purchased it for, and walked
Hey,
away.
shout out Ladarius.
Shout out to Ladarius. You know, I hope it was a good room.
You guys still friends?
Yeah, of course. Yeah, of course.
Awesome.
But so that kind of made me start thinking towards the end of the college, hey, how can I replicate this? How can I get in a housing situation where I have roommates that are helping with the bills? And so, like I mentioned, I'm just very fortunate that I started working early and was bankable before graduating college. And so I purchased that single family home. It was a 1.5 bath. Mortgage was $130,000. Mortgage was $900, and I had 2 roommates that paid $450 each. So it completely washed my housing costs from the gate, from out of college.
Wow.
Yeah,
no, that's awesome. That's by far the best investment that I would say I made as well, is early on having roommates. In the first couple investments, it really offsets. I mean, it just allows you to keep saving and buying the next couple houses as you go and leverage the financing, since owner occupied, you're always getting a little bit better terms on your note, interest rates. I mean, everything. So that genius idea.
Yeah, man.
And it really was kind of inbred in you, it sounds like, from the start, with your parents buying the house for college and kind of somewhat showing you how that works, and allowing you to learn that was a very good thing for you.
Yeah, absolutely. And I hear house hacking as, you know, probably one of the most popular advices given right now, and it can't be overstated. Like, I know not everyone's in the position to house hack. You may have, you know, a wife and kids or a husband and kids. But if you can, it's absolutely like a rocket ship.
It's a game changer.
Absolutely a game changer.
Yeah.
Your housing expenses is the biggest expense you have.
Yeah, and that's my fiance. She does not agree with this theory, but I would have roommates all the time. I did when she first was moving in. I had a roommate, and a great friend of mine. It was great. It was me, her, and then him right on the couch every night.
A lot of similarities there. We eventually had to get rid of the roommates, and then my girlfriend, now wife, ended up being the roommate, you know, and we figured it out that way. But
I'm still waiting on that piece. Like, my fiance, maybe it's time she starts bucking up a few dollars over here and paying some rent.
Mine's been pretty good about it. Mine, don't
tell her I said that, Ryan.
Is this getting posted on the internet? Yeah, I think it is.
Yeah.
She, you know, we talked a lot about goals and stuff in the beginning of our relationship. And I was like, look, I got to do this real estate thing. And so we actually ended up moving 4 times over the span of a couple years, just with limited capital and using owner occupant loans. You know, she was on board. At about the 3rd move, when we moved into a duplex, I was like, all right, she's the one. I got to go get a ring, because
she can deal with that. Crazy. I mean, that's a game changer.
Yeah, absolutely.
No, that's
and tell us a little bit. Go ahead, Ryan.
No, I was going to say, so you get the bug, and so kind of the start of your journey, your house hacking, jumping from house to house. And what, I guess, was there a certain deal that, are you still house hacking, or did you do it enough where you were able to get out of it?
Yeah, we eventually got out of it from our last house hack, and we moved to Germantown, where we live now, just us 2, single family home, sort of suburb life now. So that first house hack went up about $50,000 that first year I was living there, and ended up waiting the exact 12 months and then just moving a few streets over and putting down my savings on that house. After I had lived in that second one, I ended up refinancing the first house and pulling out a lot of that equity, and then selling.
When was this? Give us a little bit of time frame here. Was this a year or 2 ago?
So September 2019 is when I purchased the first home. So it would have been August or September of 2020 when I moved to the second one. And then probably midway through 21, I refinanced, when rates were near zero, refinanced the first house and pulled out, I believe, $60,000 of equity in the first home, and then sold the second one. And so I had these funds that I really didn't expect to have that fast. And I rolled those into a 4,000 square foot duplex in our medical district in Memphis in Midtown. And about 4 months after we moved in there, I had someone from California call and offer $100,000 over what I had paid 4 months prior for that one. And so,
Jesus, what's the reasoning for that? I mean, was there a development they were trying to bring in?
well, we slightly renovated the property. I believe we bought it under market value. We bought it for 375. He purchased for 475 about 4 months later. But he actually owned a fourplex right next door. And so he wanted to have them both, and sort of found me and called me and just said, hey, like, kind of name your price for, I believe a lot of things in my story had to do with very lucky timing on the market, to be honest with you. But I've tried to make the best decisions that I can with what's been given to me over these last few years. I'm trying to keep the money in the right spots, to keep the ball rolling. But I do think, everyone in real estate's had a very fortunate time these last few years. And you just got to keep that in mind, that you're not as smart probably as you think you are. It's just the market is going up 15% annually. So
I think we get caught up, especially on social media. Everybody's a genius these days. And I think a lot of us need to kind of step back and think about how easy it really has been. I mean, we obviously sell real estate too. That's kind of our main business, and which has allowed us to build real estate portfolios, everything else. But I've got clients that have lived in a house for less than 24 months, and they're selling and making 30, 40, 50,000, and they're not real estate investors. So it was almost a given. If you bought a house before 2020, like, I would hope you made money, because if you didn't, there's a problem.
Absolutely.
With how much the market's gone up. So yeah, I think you said it great there. Like, we've all got to take a step back and get off this pedestal that we've been sitting on, because the reality is like, a lot of this isn't going to last when there is a little bit of a hiccup and pullback in the market. And a lot of people are going to probably get stomped on, and it's going to get a little bit maybe crazy out there. I don't know. But you bring up a great point there.
Yeah, I think there's a lot of headwinds coming our way, with the rate increases and just honestly inflation on the cost of supplies and like capital repairs on real estate. It's kind of been like, oh, well, I'll buy this house and who cares if the water heater goes out, because it's going to be worth 10% more next year. And it's, negligible, that cost. But I think it's really something to take into consideration now, like operating costs for real estate moving forward. If inflation stays at the rate that it has been, can completely wash out any cash flow or appreciation you were accounting for. So I'm really interested to see like where the market heads. And I think there's potential for a lot of variable rate debt to come to maturity, and maybe wipe some people out, maybe not. It's very hard to tell, but we'll see.
So let's go on that. You get this guy from California. First, quick answer: did you know him?
No, I know him now. He was from California, but he's actually an attorney. And so I know him now. I've, talked to him and bounce ideas off of him. He's a local investor, so it's always good to know.
Gotcha. Yeah. So you make $100,000 off of that house. I guess you got a bunch of capital now. You made money on the first one. You got all this money. What's going through your head? Where do you go from here?
Yeah, absolutely. And, my story is not 100% house hacking. With all the capital that I got from that first investment and selling the second, I did purchase other single family homes in the Memphis area in that 2021 timeframe. These aren't very expensive homes. These are, $80,000 to $100,000 homes. And I was using a local lender to put 5 to 15% down on these homes. And so at that point where I sold the duplex, I got up to 8 single family homes that I had loans on and that were, stabilized and cash flowing. I ended up selling 5 of those in March or April timeframe of 2022 and netting additional cash at that point in the hopes of getting into 5+ unit multifamily with those funds. And, I had logic on why I wanted to get out of the single family asset class. I think there's a lot of arguments online about, which one's better or which one you can use to scale. So from my perspective, I wanted to get into that commercial space as soon as possible, given that I had the funds. And so that's what I did.
Could you expand on that a little bit? Why you wanted to get out of the
elaborate.
single family?
Yeah. So I was sitting with 8 single family homes, and they were rented and they were renovated, stabilized, and cash flowing. In my mind, it's difficult to operate that as a business, and it's difficult to control your equity with that asset class. Meaning, if you renovate a single family home, it's occupied and it's stabilized, the value of that home is really based on the comparable sales per square foot of other homes in the area. Meaning, you can't go force that house to be worth more tomorrow if you wanted to. And so I felt like I was in a position that I should be happy with, but I felt like I honestly didn't have much control of the value of the properties that I had. The difference between single family assets and commercial assets are based off, their value is based off the income that the property generates. And that's obviously a lever that you can pull when you own that type of real estate. You can force value by increasing the net operating income of that asset. And so that's something I just understood. I think it was a natural next step for me to continue growing, especially with like headwinds in the single family market, potentially values decreasing. I wanted to have a little bit more control over the equity in the properties. If that makes sense.
So you're looking more so for long-term equity and wealth building versus short-term cash flow.
Yeah, absolutely. Like. I think I was looking to operate real estate a little bit more as a business than something that I could retire off of immediately. I really wanted to replicate what some larger firms are doing with adding value to commercial properties. I just felt like at the time, headed into the future, it just gave me more control of like growing a portfolio in that way. I don't mean to say single families aren't a great wealth builder, and they can be. I think it just depends on your goals.
Yeah, I mean, look, like you said, it kind of good. There's arguments on both sides of the board. Realistically, is single family the best? I don't know. That's how it seems most people get started. I would say the good majority of people start that route and then maybe change it up. I personally, I love single family. I think they are the fastest, quickest, easiest to make money. Is it big chunks? Not necessarily, but I mean, you could make great money in it, right? And you could do it really with no money down. It gets a lot harder to do that without either having experience or having some capital when you talk about multifamily or commercial property. So I think single family is a great starting point to really understand the real estate process. That's my personal take on it. Absolutely. Yeah, I don't disagree with you. I do think there is a business model on the single family. Personally, if you build a portfolio and you're able to truly stabilize, you can actually sell those at an EBITDA. It's just not near as good. I mean, you're not going to have as good of a multiplier necessarily, but there are REITs that will pay out if you can prove it. It's just a lot harder, and you are absolutely correct on that. But cash flow seems to be quite a bit easier unless you just have a ton of capital or backing to really get going in the single family side of things.
Absolutely. I think single family is the place to start. My concern was that if I did scale to a 50 home portfolio in single family, selling that on a cap rate will probably not even be close to the market value for those homes. And so it just seemed like
it's a lot more work.
Yeah, it's a lot more work. And I think the retail prices were getting so far from like a cap rate valuation on the properties. And I just wanted to tie the value more closely back to the performance of the property, like over the long term. But you're completely right. 3 or 4 years ago, I wouldn't have been able to just jump into a 6 unit, but now I can.
Yeah.
And so, so now it's natural progression for me. And I didn't.
Yeah. And I think for you, Yeah, and sorry to interrupt you there. No, I think for you too, though, it's like you're in the multifamily kind of every day with your day-to-day job, right? Like we didn't talk much about that, but
Right.
we were talking before we started the show, and it's your property management, project management for a company that owns large multifamily. Is that accurate?
Yeah, that's right. My full-time job, I'm an asset manager for an owner operator, apartment owner operator in Memphis. Yeah.
So you're getting the experience. So you're seeing the other side of it, which is a lot different than most.
Mm,
So I think that in looking at like, man, I'm dealing with all these headaches.
mm.
Every individual house is a different headache versus these guys have 300 units in one spot. They can go and fix all these things at once. Like it's such a different product type, but you're getting the behind the curtains look at that without having to actually put your own capital and starting out, which is awesome. That is the best way to learn how to get into that stuff, in my opinion. And hey, I don't blame you, man. Single family is exhausting. I love it for a couple of reasons. My theory on it's always been, look, it's the easiest thing to sell when the market goes bad. So when I
True.
started out, especially no money, had other guys that I bring in on deals all the time. And the reality was like, I was so risk averse. Like I wanted to build this big portfolio. How am I going to do it? And how am I going to get other people to trust me when I don't even have any money? Right. Well, let's stick with the product that's very movable at any time. Down markets, even people are always buying and selling single family.
Mhm.
A lot of guys will say the same on smaller all that stuff starts getting more expensive and harder to offload if you need to. So that was my theory initially. Now I'm 100% on the same page as you. Is like I'm trying to shift. I'm going to keep a lot of the single family, but shifting into these other products because you're absolutely right. There is so much more money to be made on the back end. If
Yeah.
you can prove the product, you can kind of build your own equity into these things pretty simply.
Yeah, absolutely. Absolutely.
Yeah,
You're right.
and
What would you say was your biggest ache, like sorry, your biggest pain point in the single family? When it was it tenants? Was it issues with the properties, maintenance? What
Yeah,
what was
so
that?
like one big thing that just sticks out in my mind was I had to replace a sewer line on a property that I bought for $110,000. And I actually bought two on the same street, both for $110,000. I ended up selling them for $150,000, both of them. One of which
Wow,
I
that's
had a
good.
12, one of which I had a $12,000 sewer repair, one of which I didn't. And that
Yep.
one large capital item that happened on one of the houses completely ruined the return for my
Yep.
exit. And so a lot of that was one pain point was large capital items for each structure in single family. It's like each one has a roof, each one has a sewer line, and you kind of condense a lot of those capital expenses when you start to get multiple units under one roof. And so that sticks out to me.
No, that's exactly right. And I was actually just on what was I doing yesterday? I was on Twitter or something. And somebody had posted something along the lines of a big mistake a lot of investors make is once they start acquiring multiple properties, first thing a lot of them want to do is they get too busy managing those properties or working on those properties that pretty much working in the business versus working on the business. So they get so busy they stop buying properties.
Mm,
Right. In my opinion, that's one of the biggest mistakes you can make when you're in the single family space because economies of scale is a real thing. And you're saying it perfectly right there. Like one big capital expenditure in the single family space, if you have one property, it will bankrupt that property for the next 2 years, right? Like
yeah,
your cash flow is gone. When you're cash flowing 100, 200, $300 each house, $12,000 hit. I mean, that is 10 years at $100 a month. That's a lot. So understanding economies of scale it was a game changer for me personally. Realizing that hey, we gotta really ramp up our properties because owning just a couple of these is
mm,
is honestly going to bankrupt us. it becomes much easier to spread out those fixed costs, leading to lower average cost per property and higher profitability the more scale you've got, which is why the multifamily space is nice for a lot of people because of that exact concept, right?
Yeah.
It's just, again, it's so much more expensive to get into that starting out that it makes it a little harder. But there is no doubt that an AC unit, a furnace, a sewer line, a roof, any of that on a single family house, that hurts. And that's why a lot of people, when they get into this investment space by proxy, they, instead of selling their house, they want to own rentals. So they keep their one house. And then they have that one tenant that has, you have one bad tenant or one big thing happen. And it's like, holy cow, that I can't afford to pay this out of pocket, or I just lost all my, and they can't see the bigger picture. But really the bigger picture is, well, that's going to keep happening unless you really scale this thing up.
You're so right. You're so right about that. And to your point of like, it takes a lot of capital to get into multifamily right away. I see, a lot of people start with raising money to get into multifamily.
Yeah, and that's where I said earlier, it's about either having the capital or having the experience and the backing to go do it. It's one or the other. Because multifamily, you don't have to. I mean, you can raise all the money. You literally don't have to put any money out of pocket, technically.
You're right. I'd be curious to hear
have a lot of capital.
Yeah, I'd be curious to hear y'all's thought on that. I think over the next few years, especially with what rates have done, we'll be able to see if some of these newer operators really made the right decisions with raising the money. I read a lot on the Bigger Pockets, forums. Hey, I want to raise money to take down this big commercial deal, my first deal, and I just feel like that's so irresponsible to invest other people's money and make your newbie mistakes with other people's money. And it's just a really interesting part. I really prefer the way I did it, which was learn with my own money, make my own mistakes. And I'm still using my own money, but one day I probably will raise for projects, and it just helps to have a foundation. I think we'll see how all that's going to work out.
Yeah, you're 100% right. My personal opinion on it is a lot of people are gonna feel some pain. There's been everybody is an investor now. Everybody wants to raise money. TikTok, social media has made it so popular, which is awesome. I'm pumped that people are out here doing this on themselves. But I think people are being extremely irresponsible in a lot of ways. We've had a market that is straight up for 2.5 years, for honestly, like 3 or 4 years, if I'm going to be real honest. And it's still okay right now. There's still a lot of product being built. There's multifamily popping up all over the place still. That's not even a finished product. And so I think as we see more of that in the next 6 months hit the market, we're seeing, there was just an article in the Wall Street Journal that rent rates are already becoming suppressed, and people are done paying these crazy prices, which I would be too. It's insane. But I think rent rates were down like 2.9% across the country. We're not really seeing that here in Kansas City yet. I'm actually getting a lot of people reaching out saying, hey, they're raising my rent 20-30%. We need to get out. But I say all that to say, we're still technically delayed on a lot of this stuff. So like a lot of these guys that have went out and bought these properties, I think they're going to feel pain over the next 2 to 3 years as their arms start getting called and they have to start re-upping. I think rates are staying where they're at and actually going to go a little bit higher. Now, do I know that? No, that's not any advice. It's just, that's my personal opinion. I do think rates are going to actually go up a little bit more. And people that have floating debt out there, it's going to get a little scary on these bigger ones, possibly. Especially if they're maxed out. People were getting appraisals that were coming in way over value and even at value on some of these values, and values have dropped pretty significantly in some sectors. So they're still kind of riding that wave, but there's going to be deals to be had because a lot of these office buildings are vacant, sitting empty. I think that's a sector that, or a product that we can convert into many other things. And there's going to be some deals to be had there. And people are going to move. Like, landlords get in this comfort zone, in my opinion, or property owners, where it's like, my tenant loves me, they're never leaving. Oh, you want to bet? If I can go save 50% on my rent, I promise your ass I'm leaving. Like that's a big deal, especially for businesses. And there's going to be deals out there for guys that have held on to these properties for a long time, or that have had them for a couple of years even, but they're going to start sitting empty. Like they've also got deep pockets. So you're telling
Yeah,
me a new investor could compete against those guys? Absolutely not.
no.
And that's where it's going to get scary is we're going to start seeing rents get suppressed and tightened up across the board, in my opinion. Hopefully not too much, but it's going to start getting competitive out there. So you're going to have good value propositions. You're going to have to do unique things. You're going to have to offer things up. um, New investors, I hope people have cash saved up, and I
I
know a lot
know.
of them don't because I've talked to a lot of them, and it's like, oh, you don't have any rainy day. Like,
I know. I
let's
know.
hope things don't get too crazy.
For so many years, the market was just getting away from people, and they thought they just had to jump in as soon as possible. It's a terrible feeling, especially if you don't own assets when that's happening. It's a terrible feeling to watch a
Oh, it
market respond like it did.
sucks.
And I feel really terrible for people who didn't have assets pre 2020. And so they have no way to cling on to that wave of inflation. And now everything just costs more, including housing. Um,
Oh yeah.
so anyway, yeah. So I'll be interested to see. I was talking with someone on the forums the other day, and it's like, well, there's going to be a wave of multifamily foreclosures. It's really hard to know exactly what percentage of the market is that close on their underwriting. Like how much of the market is owned by syndicators who projected cap rates to decrease in their hold period, and they projected rents to go up 10% every year through the hold. I don't know what percent of the multifamily market is owned by people who have variable rate debt or have an exit point in the next 2 years. I don't
Yeah.
know. I wish I could. I wish there was data, but it's just hard to know what percent of the market is distressed. I think it's easier and maybe in office and things with a lot higher vacancies, but multifamily, the vacancy is more of like a bleed. It's a slow bleed down to like the 80% range instead of office, like one tenant
Exactly.
moves out and now you're 50% occupied. So that's immediate lockup and foreclosure point right there for office.
Yeah.
Um,
That's
so
a
it's
great point you bring up there.
yeah, it's so
Yeah,
I'm very interested.
I would say it's going to be closer to probably four-ish, 3 to 4 years versus two, just because you think
Yeah.
back, it's about a year ago, rates were still about 3.5 to 4%, which is still really good. We get to November of this year, and then it's like, oh, okay, that's really it changed, and things were 7%. And so, like, now you start clocking back, okay, where's 48 months from here? Because on most 5 year arms, okay,
Mm-hmm.
now 3 to 4 years from November ish, or this fall will be an interesting time if rates don't adjust at all. And the Fed's offering, or I don't know if they're already offering or if they're about to offer 6%. Like, why the hell would anybody invest money in a 5 cap? Or I wouldn't. I'll go put my money in the Fed. Like it's
My thoughts
crazy.
exactly. My thoughts exactly. The risk-free rate now, like in a high yield savings account, is like 4+%. And a lot of these syndication deals, I'm not a passive investor, but I see a lot of the offerings, and like the cash on cash is like 4 to 5%. And then the IRR is like, 14 or 15%. And it's all just betting on a good exit price eventually in the
It's
deal.
the
And
cash on cash at 4 to 5%. That is, I cannot believe people do that. Most of our stuff is going to be 9+%. Like 4 to 5%. Those
I
must be
know,
like the Dallas, the Denvers, the really good
right?
markets.
But there's been no yield like
That's
for the last 3 years.
crazy.
I guess people are just used to like not being able to get a return anywhere with rates as low as they are. So, yeah, I mean,
Yeah, I mean, right now to build anything new, the rates are so high. We've got a few industrial projects going, and trying to get a spec off the ground right now is damn near impossible. I mean, unless you just have really, really deep pockets, you're talking 9% or higher is what they're charging on a lot of the
wow,
spec stuff now, which is, yeah, new construction spec 9%. Like, holy shit, it's
yeah,
absurd. It makes it unaffordable. I mean, you just can't do it. You don't have any room for error at all when it comes to that. So unless you've got a tenant, good
Right.
luck. I mean, it's hard.
Wow.
Yeah.
So that's going to hurt supply then, I guess you would think, if it's hard
Yeah,
to
there's,
build.
you know, the industrial space is an interesting space, man. There's so much product that's been getting built and delivered, and there's so much product still getting delivered, and that's, you know, a few months out, construction wise and completion. Yes, it's slowed down, but there's still a lot of guys with a lot of deep pockets that are going pretty
Okay.
hardcore. Industrial space has been a hot market to be in the last 5-10 years. It really, even just the last 2 years, if you got into it, you've done well. And I think that you know, the need for it is still there. All the numbers still show like the demand is still there for the most part. It's just not in the spec world. Like you better have a owner occupant or somebody that's ready to lease it up before you're breaking ground, or else the bank's not really even look at it at this moment.
Wow.
Well,
Yeah,
hey,
it's been a hell of a ride.
yeah, and we still got some time, but I definitely want to hit on Reed. I saw on social media recently took down a 6-unit multifamily value add. I wanted to talk about that deal, kind of how you found it. We know from earlier how you funded it through your single families, but how you found that deal, and tell us a little bit about the property and your plans.
Yeah, man. So this has been my dream. This is exactly what I was hoping to find when I sold single family. It was very scary to sell those assets and see your unit number go down, but I knew it was for a purpose. So when I sold the single family homes, I looked up multifamily owners in my area and was writing handwritten letters, like
Old school.
all the time, sending them to literally to people's mailboxes. And this was 5+ multifamily units, ones that I thought I could afford, which was like the $400,000 to $700,000 range. I was thinking was where I wanted to purchase in. Anyways, I never got any responses from those letters at all. A wholesaler that I knew actually sent me a deal that he couldn't close on, and it was one of the people I had mailed, one of my favorite ones from my list that I absolutely wanted. And he actually had this seller tied up under contract to sell her 6-unit apartment building. And so jumped right on it and got it under contract for $400,000. So on the lower range. And we just closed on February, I believe it was like February 22nd, 23rd, right before, you know, we're recording this. So not a lot of
Congratulations, dude. That's awesome.
Congrats.
Thank you. So happy to get into this asset class. This really was a leap of faith to sell out.
Now, is this a value add property, or what are we talking here? Give us some information.
Yeah, 6 units. There's 2 1-bedrooms and 4 2-bedrooms. The average rent hadn't moved since 1995. The average rent was $450 at the property.
That's a bargain.
This is very close to the University of Memphis campus here, so really familiar with the area. It's got so much potential. The NOI that I purchased the property with was around 27,000, I believe, and so I bought it on like a 7.25 cap rate, which I think is lofty for the condition it was in. But this is projecting on a value add plan, so I believe over the next 2 years, for the capital on the exterior, I'm going to do a new roof, paint, and fence. Those are already quoted. That's $31,000. And then I'm going to do about $7,000 per unit of interior and HVAC work per unit. And the post renovation rent should be anywhere between $850 and $950. And so just depending on the cap rate for the exit point, you're looking at probably an NOI, moving the NOI from like 27,000 to closer to 50, which is double on the NOI. Yeah. And, you know, the plan honestly it just depends on where rates go. I've got 5-year fixed rate debt on it. And in 5 years, I'll either sell or refinance when it's stabilized. But the point
you're going to cash flow pretty well on it.
It will cash flow pretty well. Just being at a point in my life where I don't need cash flow, I guess my main incentive there would be to refinance or sell and do it again on a bigger multifamily value add. But just point being, like, I was able to take that equity from the single families and then force equity in this property, even when the market is kind of headed down. And so that's really was my plan. It's not easy. It's hard work.
Yep.
turning 6 units. But it's just sort of the business. So I have a third party management company in place to handle rent collections and tenant management because I'm not very good at that stuff. I'm a pushover when it comes to increasing people's rents.
Hey, at least
you
you're
know that
honest.
about yourself.
Yeah.
Yeah. That is not my thing. But one thing I can do is like monitor the investment plan and make sure the capital stuff gets done and things are getting leased at the rates they should. So for the residents that are currently there, it's 100% occupied. We actually gave them offerings to just bump rent a little bit and stay there. And so those residents who want to stay will stay. The residents who want to leave, we'll renovate the units and get them closer to market rent. And
Nice.
I think rates, I agree with you. I think rates will head up. I think they'll start coming back down. So valuations for these multi should be cushioned in the next 3 to 5 years. Not next 3 to 5, 3 to 5 years out from right now.
Yeah.
Yeah. So you said,
who knows? It's all a guessing game at this point. But the reality is like real estate is still, in my opinion, if not the best, one of the best investments you can get into for many reasons. It's not. A lot of people get fixated on, it's no cash flow or it's so small for blah, blah, blah. It's like, hang on a second. You got to think about all the outside benefits of, tax deductions. Cost segregation is a huge thing that I'm really starting to focus in on and learn about. And especially, fiance makes a great W-2 salary. I'm a full-time real estate guy. So, I can really leverage the cost segregation stuff. So we're starting to play with that strategy quite a bit. There's so many things outside of so many additional factors that come into it that we don't think about on the back end of real estate investing that really do pay off in long term and build not only equity, net worth, but man, you learn a lot, you build a lot of good relationships. It's a great industry to be in, no matter where rates and stuff are, if it makes sense, in my opinion.
Yeah,
it's the best.
Not to go down a rabbit anything that if we don't plan on keeping it for 10 plus years.
It's the way to do it. Not to go down a rabbit trail, but because my wife's in the medical field, like yours, but I just got married, so we haven't done our taxes together
now,
yet.
let's be safe. I'm not married.
Oh. Okay.
Fiance.
She has time to run.
Maybe you're not the right person to ask, but
yeah, so she can still get out.
you're a real estate professional and she's a high income W-2. The real estate professional status only applies to the real estate professional side of the income, right? Or can it apply to both if you're married?
Yeah, if you're filing taxes together, if it applies to your overall household.
So you can wipe out her W-2 tax liability with your
exactly.
Yeah. That's incredible. Yeah.
And for our lawyers, this is not professional tax advice.
Yeah. We're not CPAs, anything else, guys. But if you are a qualified real estate professional, which a lot of people say they are, they aren't. So you make sure you are with your CPA, whatever else. But yeah, it offsets it. So that's a big deal. And that's something that I'm like, holy cow, if you can figure out the cost segregation piece too, where, we've had accelerated depreciation. Now it's changing this year to 80%, I believe, versus 100%, but that's fine. When you're talking multifamily or commercial, you're still talking several $100,000 on a multifamily or commercial unit that you can get year one depreciated. So if you're a high W-2 earner, or your spouse is, I apologize, if the spouse is a high W-2 and you're a real estate professional, man, you can be buying these properties and leveraging the cost segregation and depreciation I look at it as I'm getting these things for nothing out of pocket, right? It's like, holy cow, obviously you got to put the money down, whatever else, but like essentially you're just getting that money back. Yeah. So it's an offset.
Same thing with the vehicle.
It's crazy.
I know it
really is a crazy. I say loophole. A loophole's not a bad thing. There's a lot of even my fiance, she gets all worked up when I say it. She's like, blah, 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 blah. I'm like, look, I pay all the taxes. I'm not trying to do anything to fight the tax, man. We pay our stuff. these laws were written the way that they were written, and
Right.
we're not taking advantage of them. It's
You're
the
playing by
law.
the rules.
We understand them. We're playing by the rules.
Yeah.
And guess what? We get to maximize it because we paid great attorneys, great accountants to do it. We couldn't do it on our own by any means, but we have a great team, and it's crazy the way that you can take this and really run with it if you
It's
understand
amazing.
it.
I mean, but it's like physical real estate does depreciate. Like it does depreciate. It's just not like a loophole. It's, someone has to maintain the structure and provide the housing or the commercial spaces, and things do depreciate, and they're very expensive when they break.
Yeah, the cost segregation stuff's super interesting. And like I said, I've just started digging in and learning a lot about it. And a lot of people on Twitter I've learned it from, actually, and just started reading and researching. But it's pretty interesting. Like 27 and a half years depreciation of real estate is kind of the IRS code, right? So we're 27 and a half. But if you do the cost segregation studies and you get the engineering and all the reports and everything done, like things on the exterior, like landscaping, gates, other stuff, I believe it's like a 5-year depreciation versus 27 and a half. So like you can break up sheetrock on a wall has a life cycle. HVAC has a life cycle, electrical, all of them have different life cycles. So if you pay for these studies and these reports to get done, you can depreciate a lot more up front versus saying, okay, the property was 400,000 divided by 27 and a half years. We get this amount, depreciated every year. It's like, no, actually do the study, get the stuff done, and you can appreciate way more year one. So then you take that and you leverage it with, okay, well, how much am I paying in taxes, or my spouse paying in taxes on their W-2? Oh, all right, I'm a real estate professional. Now let's play this game and figure out how to really leverage it to build a portfolio with really no money.
You're right on the money, man. Like I've debated other asset classes before, like the stock market, but it just you just can't ignore this stuff with real estate. Like you'll never be able to buy a stock 20% off of what it's worth. There's just things you can do in real estate. Like it's just unavoidable. Once you're in it,
if you understand financing and stuff too, like, man, there is no better. If you could truly understand taxes and financing in real estate, it is crazy the things you could do.
It's incredible.
Like we were saying earlier, multifamily, you really don't have to have money. Like if you understand and you have people that will give you money to go invest, you can just raise the capital. It doesn't matter. All the bank cares about is the fact that you have X amount of capital to put up on the project. It doesn't matter whose capital it is.
Yeah,
so the
but
reality is like you could get in with nothing.
Yeah, and then if you own a percentage of that building, that you capture the depreciation on that, then you're getting the tax benefit. It's
exciting is what it is. I get so worked up.
Me too.
Yeah. So
I think Ryan, I think we need to start wrapping it up.
Yeah, we do. So Scott, do you have any last questions for Reed?
No, I don't think so. I really appreciate your time coming on, though, man. You've got a bright future ahead of you. I'm excited to hear a little bit more over the coming months on how that six unit property you just acquired ends up going, and just keeping in touch. We'd love to have you back on the show to talk here in 6 to 12 months and give us an update on what that looks like, and hopefully you're into several other properties and really kicking butt. I think you've got a huge runway ahead of you, so I'm excited to continue to keep in touch.
Yeah, I got to get to work, I guess.
Yeah, I did have I got a selfish question. So you said that 6 unit has kind of been a dream of yours.
Yeah.
Emotionally, what more exciting, when you signed and closed that 6 unit, or when you got that new beautiful white Corvette? So mid-engines, Scott. He's out there in Memphis.
Yeah.
Okay.
So, wow. What felt better is the 6 unit.
Okay.
It really did. I actually don't have the Corvette anymore. I gave it back.
Really?
And, I went through a lot of emotions in that time period where I had more money than I thought I was going to have at that point in my life. And that was one of those things. I think it was honestly, I'm a car person, so my car chapter in my life is not over, but I think I did it for the wrong reasons. I do love the mid-engine Corvette. It's like I love the way that looks, especially for the price.
Right.
I think after I drove it off the lot, I drove it around for a little while. I just realized like I put $60,000 down on that car, and I was like, I guess I'd much rather have that just to put down on more real estate. And like at that point in my life, I think I just wanted to show people that I was doing well, and it really was for the wrong reasons. So that was a big, just interesting introspection at that point in my life.
Man, I'm sure I felt good to drive that thing around for a little bit.
It was great. Yeah. And man, those cars are awesome.
Oh, thanks for your honesty on that.
Yeah. No problem.
Yeah, one of these days, delayed gratification is a big thing, and that's something that I would say I'm pretty good at. Is just I can wait to get that, and I'm more focused on building what I want to build right now, and I'll have that in the future and 10 more of it, right? So being able to delay that is a big deal, and it's kind of a maturity thing too. Like as you start to grow and mature and realize like what are you really set out to do and what are your goals financially and long term, and things change as you get older. Like I used to love things that shined a lot as well, and I had some cool stuff, and I was just like, man, it's all kind of for nothing at the end of the day. Like who reflects into our friends, social media, like who really cares? You might get a like for a second, but the reality is like, why don't you build financial freedom or wealth for yourself? But if that's not what you want, then that's not what you want. Like, hey, I love nice stuff. So there are some things that I do splurge on. You just got to learn, where's that happy medium. And I love buying real estate though. So like, maybe that's my selfish thing is I do really love to buy new deals.
Scott, you ain't fooling nobody. You ask Scott, hey, what time is it? He's like, let me check my Rolex. It's
No.
I got a Garmin on, gentlemen. I'm not wearing a Rolex. I'm training. I got this Ironman here in 11 weeks. And
that's awesome.
My coach is freaking out. He's like, are you sure you're going to be ready for this? I don't know that you will be. I was like, just send me this up. I will be ready.
Nice. All right. Hey, well let's wrap.
Oh, sorry. Well, I was just going to say I thought it was a bit more of a tactical purchase because those were very hard to find. Those cars were very hard to find at the time. I was under the impression that they were going to hold their value. They were going for so far over sticker. And I bought that in like mid second quarter. Anyways, I bought it early 2022 and rates were still low. And when rates started increasing, the used car market started to take a dip. I was like, oh, maybe they're not going to be worth over $100,000 next year. Like maybe I timed that wrong. So anyway, it's just one of those times.
People were
you gotta
buying
be so
them and
fast
flipping
in
them.
that. Yeah, you have to be fast, and you got to be one of the first ones to get it for that to work.
Yeah,
right.
The Ford Broncos were doing the same thing. People are buying. A friend of mine, Robert Mayo, he bought one and he's going to keep it, but he's like, dude, I had a person, I forget how much it was, 20 or 30,000 over. So he's like, couldn't not sell it. Like,
it'd be stupid not to.
So, when I can get the same car for 60 grand in a few years, I'll probably do it then. You know what I mean?
Exactly.
I didn't want to be holding the bag. So
Yep.
Well, let's wrap it up here, Reed. It was great having you on. Is there anything you want to plug before we sign off?
No, I'm on Bigger Pockets, Reed Rickenbach, and on Instagram, Rickenbach Real Estate. So that's just, I got nothing to sell you.
Well, perfect. We appreciate you having on, and everybody, thanks for listening. Be sure to follow us on social media and all places you listen to podcast. Scott, any last words?
No, I appreciate it, Reed. It was great talking to you, man. And like I said, I really look forward to keeping in touch and seeing what it looks like here in the future for you. And please reach out if there's anything we can help you with. We would love to keep in contact. And if we're in Memphis, we will reach out and hopefully link up.
Yeah, we'll get some of that Memphis barbecue.
If you're ever in Kansas City, let us know, man.
I will.
All right.
Yeah, thank you all so much.
Thank you. We'll catch you on the next one.
Thanks, Reed.
All right.